I'm Andrew Seaton, Executive Director of the British Chamber of Commerce in Hong Kong, and it's a great pleasure to be cooperating with Thomson Reuters on this event, which has turned out to be more timely than even expected yesterday. I've been talking about the possibility of a British exit for the referendum for some months. There's been an extraordinary evolution here in Hong Kong with Hong Kong businesses and Chinese businesses, many of whom heavily invested in the UK. Frankly, 3-4 months ago, people were not aware of the referendum, and to the extent they were aware, there was a very strong presumption that Britain would stay in Europe. Well, that has changed somewhat, hasn't it? As markets have shifted over the past few weeks, as the possibility of a British exit has become stronger, certainly the level of interest I've seen has shifted enormously. And here we are today, very, very dramatic news coming through from the UK. It's looking, I'm not making a prediction, but it's looking at the moment as if the UK could be heading for an exit. An exit, which if it happened, will clearly have major implications for the UK, major implications for Europe, implications for global markets, and of course for businesses in this region. I think we're going to be looking at some of those implications. We've got a very, very terrific panel lined up to look at that. And of course there'll be short-term implications, and we're seeing what the markets are doing this morning, but there's longer-term implications as that process of thinking about how and deciding how Britain's going to be relating to Europe moving forward, how that moves ahead, and what that's going to mean for companies thinking about their own positioning. As I said, we've got a terrific panel of speakers lined up. I'm going to be handing over in a minute to Sanjeev Chatrath, who's Head of Asia Finance and Risk for Thomson Reuters. Before doing so, 3 housekeeping points. Could I please ask you to stay seated during the discussion? Second, could I please ask you to put your mobiles onto silent mode? And third, could I say, please no flash photography. So it's a great pleasure to see you all here this morning, and I think that says something about the interest in this debate. Look forward to getting back with you later. I know I'd like to hand over to Sanjeev Chatrath. Thank you very much.
Well, thank you very much, Andrew, for the kind remarks, and thank you to the partnership with British Chamber of Commerce also in putting this agenda together. So it is my pleasure to welcome all of you to the offices of Thomson Reuters in Hong Kong. We are also live streaming this across the world, given just the interest in this particular topic, as Andrew just noted. Clearly, UK, given it is the 5th largest economy in the world, has a very significant role to play in the world economy. And as the results this morning are unfolding and they are still breaking out, the implications are going to be digested and interpreted. From Thomson Reuters' point of view, we are very, very proud of the role that we play in terms of providing trusted and information that can be used for financial communities to navigate all the uncertainty in the global markets. In that spirit, it was a foresight of the team to have put together this particular forum to be able to inform the markets based on trusted news and not based on rumors. We are proud of the role that Thomson Reuters plays in the global financial markets, which has stood the testimony of time for more than 160 years. It is evidenced by the fact that from a global financial markets point of view, a lot of the fundamental bedrocks of the markets are using Thomson Reuters technology to be able to navigate the uncertainty. As an example, it is not very commonly known that pound sterling to US dollars, which is getting a lot of focus today, referred to as cable, is referred to as cable for a Reuters cable that runs across the transatlantic to transmit real-time pricing for pound sterlings and US dollars. We are excited about the agenda that we've got collected today. It is my pleasure to be introducing my next partner, who's going to be initially giving us a few thoughts with the breaking views as news is breaking through. Peter Thal-Larsen, he's our Reuters editor for Breaking Views and an authority when it comes to providing opinions and insights on many of these news articles. So I'm going to welcome Peter to come and say a few words and then hand over to the panel. Peter, over to you.
Thanks. Thanks very much. Thank you. Yes, Sanjeev, I'm just going to try and give you a little bit of a insight into what's been happening over the last few hours. I have to say that we're not making any predictions. Reuters has not made any predictions yet, but I think at this stage it's fairly safe to say that it looks very, very likely that Britain will be voting to leave the EU. I think we're on about, well, you see, at least you can see it on the board there, we're on about 24 million votes, something like that, counted. Just over 300 of the 380 districts have declared their results, and Leave is in the lead. Just so for context, it depends slightly on the turnout, but the current thinking is that to win, to get a majority, one side or the other will need, I think it's something like 16 million votes, but I think that's on the assumption, I think, of a very high turnout. So that number can move around a little bit. But I think what we can say is that based on the results that we have so far, it's been a better than expected outcome for the Leave campaign pretty much across the board. We saw, I was up early this morning, and we saw some of the early results come in from places like Sunderland in the northeast of England. Sunderland was expected to vote for Leave, but voted for Leave to a much greater extent than people had expected. Something like 61%. People had probably expected about 55%. Hartlepool, another kind of strong working class area in the north of England, went 70% for Leave. And these are big numbers. And the reason this outcome has been so hard to predict, and the reason these numbers matter so much, is because, first of all, there is no precedent for this. I mean, the last time Britain had a referendum on this, it was in the early 1970s. So there's really no track record. You can't compare one result to the previous result and say, well, this is a swing in that direction or that direction, which is what happens in a general election. The other thing is that every vote counts. This is not a parliamentary election where you win a seat and then you that's one notch, and then you move on to the next one. The turnout matters. The absolute margin matters. And what we've seen so far is that, generalizing very much, the turnout in the Leave areas has been higher than in the areas that have gone for Remain, and has gone for Leave by a bigger margin than people expected. The one exception to that is London, where we've seen a number of the constituencies in London, Lambeth, Wandsworth, Islington, voting sort of 75% in favor of Remain, which is, again, is probably even more than people expected. But the turnout in London has been a bit lower than people expected, around the mid-60s. It's, as things currently stand, it's very hard to see how this ends up being a Remain vote. It looks pretty solidly like a Leave vote, and that is not what people were expecting this time yesterday. So that has had sort of predictable consequences. I mean, in the financial markets, we've seen really very, very sharp moves. I mean, the sterling against the US dollar started, I think at least the morning in Hong Kong, around the 150 mark. Last time I checked, it was at 135. I mean, these are absolutely massive moves. And really, I mean, when you think about it, not surprising when you have what is essentially a binary outcome, and kind of something goes against the probability in such a way. We've seen, obviously, the sterling futures are down. Shares in HSBC and Standard Chartered, the Hong Kong listed stocks are down 5, 6, 7%. And people are rushing into the safe havens. The yen, I think, was up at 101 something to the dollar when I last checked. There was something coming across the wire about the Japanese having calling a press conference. There's an expectation probably that there will be some kind of intervention, maybe in the yen. Possibly we'll see some more interventions, and then everybody rushing into sort of other safe havens like U.S. Treasuries and so forth. But those are the sort of short-term gyrations, and that's sort of really the markets, trying to sort out what is going on and trying to sort of adjust to this surprise. But I think looking a bit beyond that, just trying to think a little bit beyond some of the sort of the immediate consequences to this. And again, it's early, and we have to sort of see where the results settle. But if this is the result, if it is a sort of 3-4% margin in favor of Leave, then well, first of all, you have massive political turmoil in the UK. I mean, both main political parties were publicly campaigning to stay in. The government more enthusiastically, I think, than the Labour Party. But those, I think, particularly, I mean, the government's position, David Cameron's position, has to be in question, I think, in the medium term. And that matters because what happens now is that you trigger a clause in the EU treaty, in the EU sort of the founding treaties of the EU, whereby Britain now begins the process of leaving, and that's sort of starts a 2-year clock ticking, and that basically means that Britain needs to negotiate the terms of its divorce. And so at this stage, I mean, that is fraught with uncertainty. It means renegotiating all kinds of things, access to the single market, terms and conditions. What kind of conditions are people going to accept in terms of movement of labor? What kind of access is Britain going to kind of try and seek to the single market? What sort of trade-offs are going to have to be made as a result of that? What kind of financial contributions will have to be made? What will be politically acceptable? The first thing is, it's not clear who's actually going to be having those negotiations from the British side. So that's one uncertainty. And the second thing, I think, is that this result, especially, I mean, assuming this is the result, and as things currently stand, it's not really clear what it's a vote for. You could argue it's a vote for less immigration. That seems to be one of the big themes of the campaign. So, which would sort of imply, you know, leaving the European Union, putting up some barriers, kind of restricting the free movement of people, etc. But at the same time, you've also had people say this is an opportunity for Britain to throw off the shackles of Brussels bureaucracy and make its own way in the world and negotiate free trade agreements with other countries and so forth. So there's a real dichotomy there, which is on the one hand you're talking about immigration, on the other hand you're talking about freer trade, and it's really not clear how that's going to be sorted out. I would say that it looks like it will probably be in the EU's interest to make things quite tough for the UK. I mean, that's been made fairly clear during the campaign for a number of reasons. One is just, you know, if one country leaves the EU, especially a large country like the UK, then of course it emboldens other anti-EU, anti-Euro parties into thinking that they could maybe get a similar result. And so there will be quite a strong incentive, I think, in the EU, in this sort of EU leadership, to make things quite tough for Britain, and to basically say, well, if you're going to leave, these are the consequences. How that quite plays out, I don't know, but I think that's the sort of the starting point, I think, for the negotiations. Obviously has massive implications for London as a financial centre. I mean, Britain operates as a financial centre in Europe partly because of its access to the single market. It has access to, you know, but you can operate from London, you can operate around the whole of the EU through the single passport. It seems to me quite unlikely that that will be able to be retained in its current form. So that means banks thinking about moving people out of London. Where will they go? Will they go to Frankfurt? Will they go to Paris? Will they go to Dublin? Will they go to Amsterdam? There's going to be lots of mayors of lots of European cities flying into London saying, why don't you think about bringing your traders to my wonderful city? And that will be, and I think there will be some consequences for London. And there will obviously be some consequences for you know, foreign investment in the UK. People thinking, well, do I really want to own a water company or an airport or you know, a Mayfair apartment or something like that, if this kind of thing is possible? But more broadly, I mean, I really should wrap this up and let the conversation begin. But I think this is something that we've been talking about and seeing for a while across the world, which is essentially a sort of, you call it a rebellion against the elites. And this is a massive rebellion against the elites, right? This is not just the established political parties in the UK who thought this was a good idea. This is the Bank of England, this is the IMF, this is the leaders of large companies, all of whom saying, really, you know, kind of, guys, this is really important, you should actually stay in. And they have been ignored to a certain extent. I mean, we talked about Sunderland earlier. Sunderland is home to a massive Nissan plant from which they manufacture cars which get exported across the EU. If there is a beneficiary of being in the single market, it is a place like Sunderland. But that does not seem to have been enough to actually persuade people to vote to stay in the EU. One final thought, I guess I would say, I think this is probably the most interesting, well, one of the interesting things about this is that this sort of makes unthinkable things thinkable. So, you know, I think, obviously we know this has been close, but I think there was probably a feeling that people at the end of the day, when in the ballot box by themselves, faced with the ballot box by themselves, would think, well, they would vote in favor of their own economic self-interest. they would vote for the status quo rather than the uncertainty of change, you know, that they would probably swing at the end to remaining in the EU. But if, I don't know, if you can have swings like this, if things like this are so unpredictable, then what other unpredictable things could happen? Do you suddenly, does it become more imaginable that we have a President Le Pen in France, or does it become more imaginable that we have a President Trump in the US? So I think it does throw potentially a lot of things up in the air, even if we're not quite 100% sure yet. I think that's the direction of travel. And I should, at that point, hand over to Tara and bring up some of the other more experts who can talk about this.
Thank you, Peter. Stay up here with us. If I could ask our panelists to come join us on these stools, right by the map of the UK, so we can keep in touch with what is going on minute by minute. Peter, would you like to join us and have
absolutely.
a seat?
Yeah,
Hi, everyone. My name is Tara Joseph. I'm actually based in this office, and I think, like myself, I'm looking at a lot of people around me that I know. The penny is starting to drop, both emotionally and trade-wise, as to what really could be happening in the UK. And as we're seeing on the Reuters wire, whether it's trading floors in Hong Kong, trading floors in Japan, trading floors in the Middle East, as London wakes up, the implications of what happens today is really, really vast. And I think there are few historic moments in life, but we might all be sitting together right now and experiencing one of them. I'm pleased to have a really interesting mix of panelists today to discuss, once we get over the shock of what really could be happening of Brexit, some of the implications and what we should watch for going forward. Peter Tal-Larsen, my colleague at Reuters News with Breaking Views, you all know, and also Keith Hodgson, who is an expert in terms of financial services and the financial services industry. Mike Spencer is with Deutsche Bank. He's a managing director there and head of economics. Before you were at Deutsche Bank, you were also with the IMF, so have a very global view in terms of economics. And Binay Changotia, who I've had the pleasure of interviewing before, is a portfolio manager, an asset manager, really has a sense of the different asset allocation strategies that we could be looking at once we see what is really the news out there today. So, Binay, if I could start with you, how are you positioning yourself today? Is it just risk off, or is there some risk on that we could think about?
There are two ways you can do it. You can be in the office and trying to do something, or you could be here talking to people. I chose the easier one out. Yeah, but yeah, this is like kind of almost like a binary event, and you could easily see what could happen if things went one way or the other. So you've got treasury yields going down, gold going up, pound getting hammered, Japanese yen breaching 100, I think.
Has it gone through 100?
And of course, equities tanking. But that is, it was always known that this is going to be a hard trade to do, you know, as soon as you get the results. So therefore, you've got to think about what lies ahead. One of the things that I'm thinking of at this point in time is what kind of action you would expect. I think Peter talked about Bank of Japan getting together. I actually think there will be a coordinated global action to kind of soothe fears, because the crux of the matter here is dollar liquidity. The dollar shoots up, it rises significantly, and you have problems across the board. So you would expect the Fed to come out and do more currency swaps. You would expect the Fed to actually forget an interest rate hike this year. That is not in the cards to my mind. You probably expect more, I'm not a big supporter of that, but more negative rates in the euro area, probably even Bank of Japan. I don't think that helps a lot, but maybe Mike is a better place to comment on it. But yeah, so you would see some kind of coordinated action there, and then you take a view on how you position the portfolios depending upon your risk and your objectives. So there will be a lot of losers, there will be a few winners as well, and that is what we do all the time.
Let's start with that idea of global coordinated action. Keith, you are nodding in agreement. Is that going to be in the next 24 hours? Are they already talking on the phone to each other? And, well, let's leave the Bank of England out for a minute, but what kind of global action would we likely see?
I think there are a number of things that are out there. I'm an accountant, and we usually say there are only two certainties in life, death and taxes. I think there's a new certainty, and that is uncertainty, which is a level of volatility that we're going to see over the next hours, weeks, and so on. Globally, trade does not like uncertainty. Trade likes certainty. And we prosper as a planet generally through trade. So I think we are going to see central banks thinking very closely and hard about this. The cost of intervention could be high. So I think people are going to think through, are there smarter ways to do this than just straightforward intervention in the markets? There's a lot of emotion in the market. We've seen sterling move 150 down into the low 130s. Is that sustainable emotion? Is all the information in the market at this point in time? I think there is so much uncertainty that most people don't know what the next hour, day, month is going to look like and what that means for their organizations. And so to believe that this is the new normal is probably naive. So I think people are going to be, the central banks are going to be talking, they must be talking, I'm sure they've been talking for weeks, months around this, thinking through what can be the scenarios and what can be the outcome. But I think they're going to be cautious, they're going to be measured, thoughtful. I think they need to be that way. Obviously, if there are real major economic issues that need to be addressed short term, I'm sure we'll see action. But I would caution on the side of let's work out what this really means before we make big-scale economic intervention.
Well, Michael Spencer, surely there's been a plan B or a plan Brexit that should this moment come. Are the central banks, the way banks themselves and companies sort of already ready to go and press that plan B button?
Well, I think we've already begun to see it this morning. We are seeing central banks in the market trying to provide liquidity in the FX market. I don't think they're necessarily trying to move the market the other way, because to the extent that this is emotion, it'll flip back tomorrow. I think we know the major central banks have dollar liquidity lines and swap lines between them. If we see interbank rates spiking up and there's a genuine liquidity shortage, the infrastructure is there to solve that problem. But I think, for example, as we get into London trading time, I'd be surprised to see the Bank of England in, for example. I think if you're looking at the economic impact of a Brexit, a devaluation of the pound was a natural thing to expect. And so for them, this isn't necessarily a bad thing. For the BOJ, this is utterly in the wrong direction. But to be honest, I mean, to Binay's point, I'm not sure what the BOJ can do, right? And the ECB as well. Cutting interest rates when they're already negative doesn't look like it's going to weaken the currency. It doesn't look like it's going to impress anybody. And to the extent that politics matters for central banks, and at the margin it must, if this is a vote against the establishment, can the establishment take interest rates on deposits or pensions down even more negative? I think we're not going to see that. I think we'll see liquidity lines between central banks to make sure markets function, and just let the FX market settle where it needs to.
I'm starting already to think back to the last time we had a kind of crisis of this level. I'm thinking of the financial crisis now a decade ago. Peter, do you think we're on even territory in terms of the impact and the scale?
No, I think 2008 was much worse. I mean, I think that it was a global crisis. I think the unthinkables that were becoming thinkable at that point were on a much bigger level. I mean, to a certain extent, this is a surprise, but it's not exactly as if you can't exactly call Britain leaving the EU a sort of black swan event. I mean, we're having a referendum. It was going to go one way or the other. And I think you're right. I mean, I think there will be talk between the central banks. Apparently, there is a Basel meeting this weekend, so they're all going to be in one place anyway. So if there's any kind of action that needs to happen, that will happen. I think actually
maybe they have a WhatsApp group and they're like sort of sharing it.
It would be good to get on, wouldn't it? But I think it's the sort of the bigger political uncertainties really that are harder to call here, and just sort of the consequences. I mean, I've had conversations in recent months with people in Hong Kong, very big people who run very big companies who've made very serious investments in the UK, who say, well, if this result goes the wrong way, then I don't know, how certain can I be about the regulatory framework for the assets that I own, and whether that 20-year contract or whatever it is that I've got is going to be honored. Kind of what happens in the next election, what kind of, if the whole relationship with the EU gets renegotiated, then what is the legal sort of political framework I'm operating in the UK over the next 2, 3, 5 years?
So the actual thing is that the result opens up this massive unknown. So Binay, how does one trade that? As a portfolio investor, let's not talk about minute-by-minute trade. Like, how do you balance out a portfolio?
So ultimately, you make kind of money by buying assets cheap. So obviously, there are going to be some winners. For example, if trade suffers to an extent, and UK is a fairly large importer of goods from across the border in the EU, like I think about 100 million pounds of annual net import of goods. The big exporter of services. So you probably have a trade where you go look for areas where companies supplying to domestic UK market will gain, maybe small caps, mid caps in certain areas where they can start manufacturing back home. You probably, maybe short some of the services sector companies because they're very large net exporter, and there's going to be uncertainty for about 2 years about how the laws shape up. So you have to do that kind of a detailed analysis on what outcomes can play out and then position the portfolios accordingly. And of course, because we are talking about politicians, we're talking about protracted negotiations, legal issues, you can never be too sure. So you go in with some hedges in the portfolio as well. Like one of my hedges in the portfolio over the last few months was retaining a long bias towards fixed income bonds compared to cash, because the natural outcome of an adverse event would be that bond yields are going to go down significantly, right? So even though it was costing us some performance for some point in time, it's an acceptable hedge because, again, it's one of those hedges which has got a positive carry, not a negative carry, because all hedges by definition tend to be with a negative carry, right? So you got to spend a lot more time in the broad macro thing is done now, but a lot more time on the nuances of what brings in the opportunity and what brings in the risks. And kind of going back to the question on what this means, maybe it's not as much about central banks, it's about the political establishment in the world. And maybe you see more fiscal efforts by G7, G20, to win back the voting community. Maybe central banks, as I said, negative rates, I don't think it helps, actually. It's negative, if you ask me. Maybe Bank of Japan goes out and buys assets. They increases the purchase of ETFs and REITs. And of course, I think you probably see more fiscal spending, to my mind.
Mike Spencer, in terms of global impact, are we now sort of, along with the political implications, seeing, I don't want to say the death of global trade, I think that's a bit overdramatic, but are we going to see this massive retrenchment from sort of a globalist, a global trade environment, people kind of retrenching back to their home bases?
Well, what will happen in the US will be far more important. I mean, it is not the intention, as far as I've understood it, of the exit camp to become an autarkic economy. They just want to rewrite the rules of engagement. I think they will find it's a lot harder to do that in terms of maintaining access to the European markets on anything like the current terms, but the UK will always be a trading nation. So we probably, from that score, have to worry more about
Trump. A lot of people want to trade with the UK. I'm thinking about the EU in particular, or...
Well, so I think both of them, I mean, the EU will have an interest in penalizing the UK. It's going to be very difficult for the UK to maintain tariff-free access to the continental European market. But they will both continue to try to liberalize trade with other countries. So I don't think this is the event. I mean, this event is more important in terms of the broader backlash against a fundamental economic and political philosophy that's driven growth over the last 30 or 40 years. In that sense, yes, it's part of this gradual withdrawal, but I still think the US election could be much more important. If you get a president in the US that comes in and says, right, I'm going to start tearing up trade agreements, that's way more important than what's happening this morning. Okay,
so if it's not trade, what, in your view, is the global economic impact of a Brexit, if indeed it does happen?
Well, truthfully, the global economic impact is not huge. The UK is the 5th largest economy, but it's a relatively small market for everybody except the Irish and maybe the Germans. So those economies will take a hit. That will be offset to some extent by the diversion of investment that has gone to the UK that really was intended to make things for continental Europeans. One can expect over the next few years some of that gets diverted to continental Europe. So I think the economic impact is not huge outside the UK.
Interesting. Keith, in terms of financial services, however, London, okay, UK, 5th largest economy, but London, is it the top world financial center? Certainly in the top 3. So what are the implications for banks and financial services houses based there? I've heard some people saying it might benefit Hong Kong and Singapore, for example. Is it possible to work that out yet?
I think, as I say, there's a lot of uncertainty out there. Just put some of the topics on the table. Peter touched on them in some of his opening comments. There are 2 real large things. One is London as the EU trading centre. Does that come into question? The other one is really the ability to passport within the European Union. So international banks having a trading hub or a banking hub in the UK and being able to passport into the region, into the EU as a whole. There are a couple of other things on the other side of this. It doesn't mean that those are dead, those are blown up, far from it. There's a lot of uncertainty, as I said. One is that the European regulatory framework is a relatively sensible and robust framework. I would be surprised if the UK moved dramatically away from that, and if anything, we see regulation becoming more globalized and more consistent. And to Peter's comment about the Basel Committee, I'm sure, if I was going to think from a supervisory standpoint, I'd be making sure that the UK understood that they would maintain by the rules, and I think that would be a normal expectation. So I'm not expecting there's going to be a massive change in that. The EU expects a level of equivalence if you want to enjoy the benefits of the European Union. The UK is highly likely to maintain enough of its framework similar enough to the EU to maintain that equivalence. Financial services is an enormous industry for London. So there are huge incentives for the British government. There are huge incentives for the financial community to remember what is good about London. Let's not throw the bath out with the baby out with the bathwater here. Speaking to the other side of the equation, it is difficult to find the depth of talent that you have inside London somewhere else for people to move to. You could see people moving individually and tapping pools of talent, but there'd have to be enormous changes in labour flows for that to occur, and particularly highly talented labour. And London has done an exceptional job of pulling some of the best people in financial services together in one place. Again, do I think it's a disaster has occurred or something? No, I think we've got uncertainty. There are a lot of things we do not know. We do not know about EU equivalence. We do not know about the regulatory things. It will be unlikely that we'd see fast moves in talent and so on. It will be interesting to see how the financial community feels about this. Basic things. Trading is increasingly an online thing rather than a geographic thing as well. Is it important that people are geographically based in a certain sovereign nation? Is that really a question that's important anymore? There are a whole load of things that we need to think through. And I think that we've seen a lot of emotion flowing in the market. And I think maybe now it's more the time for that thought and thinking through what this practically will mean.
Mike Spencer, from your view as an economics specialist, here we are on a hot, sunny day in Hong Kong. Is Asia looking like a pretty good bubble to be in? Is there much impact for us here in Asia?
I don't think there's a huge impact from us here in Asia, except to the extent that companies had invested in the UK unhedged and they've taken a big paper loss on those investments. We're in a bit of a sideshow. There will be, I think, over the next probably 3 years or more, a very, I think, acrimonious negotiation between the UK and the continent. I think just as the UK will want to protect financial services, you can be darn sure that France and Germany are going to want to steal as much of it as they can. And there are some things they can do, I think, to divert people and resources. From our perspective in Asia, near term, there's going to be a hit. Growth in Europe, as well as the UK, is going to be much weaker over the next 3, 6, maybe more months down the road. The more the uncertainty, the longer that period of weak growth will last, and the more that will hit exports from Asia. I don't think we in Hong Kong are going to benefit from any bad news hitting the financial centre in London. So for us, I think this is a second order issue. This is not going to be a big impact on growth here. It will be a big impact on some companies, and we're obviously seeing a lot of market volatility. But I think that dust will settle.
And except maybe for whoever wants to address this, real estate investors. There are many of them in Asia, China, Hong Kong, investing in London property. I bet a handful of people in this room have London property. Surely that's going to hit the bottom line in a lot of banks and people's portfolios.
Yeah, but just take a step back. I think the pound was kind of under 140 till some time back anyway, till 5 days back, right?
No.
So
145.
145.
It's basically, I mean, I looked at it this morning. It's been below or around 140 on a handful of occasions in the last 25 years.
If you just look back 3 months
92,
back.
2001, 2008, and now.
Yeah,
I mean,
but if you just look back 3 months back when the Fed was about to hike interest rates, the pound was about 140, right? So we've gone down to 132, 33 today. Now, is that such a big move? I mean, as compared to the morning when we woke up at 150, it's a big move, no doubt. And it was expected because the market was clearly in for a remain. Equities were up overnight. Equities have been up for the last 1 week. Gold was down. Yields were up. So it was expected, I mean, it's not such a big move if you just widen the horizon, time horizon. I don't think it's such a big move. What happens from here on is going to be more important.
Well, and I think, if I can just add to that, I think you're right, there'll be a lot of volatility. But also, when you look at the structure of the UK economy, you can say, well, the exchange rate is a good adjustment mechanism. Mind you, Britain had a big devaluation in 2008, and its balance of trade hasn't really improved at all in that period. And in the first quarter of the year, lest we forget, Britain had a 7% balance of payments, deficit. So, essentially, there is a risk. I wouldn't call it more than a risk, but there is a risk that there's a funding problem in the UK, and I think that's something that will weigh on people at the moment. All that money that's come in to buy property or utilities or whatever, if that stops flowing, then there's an immediate problem.
Yeah, they have a 5% current account gap, which is the issue, right?
Yeah.
I think you've also got to temper this with the balancing effects that the market does deliver. Sure, those who have been owning property, there's this rather cute video showing Peter on Twitter earlier of this panda sort of destroying a desk.
Was that you in a panda suit, by the
No,
way?
it wasn't me in the panda suit. But this sort of states, if you are a Chinese investor who bought London property at a 150 or 155, maybe you're going to be a bit peeved this morning. However, if you haven't bought assets, there are no bad assets, just bad prices. And the UK market has become very cheap very quickly if you want to invest in assets. So, you would have thought there's going to be some sort of bounce back effect as hot money, looks for yielding assets. Remember, the FX doesn't change the yield on the asset. They look for good yielding assets and invest into that market, and maybe we'll see some bounce back from that. So I think it's really too early to tell what the deeper impact is going to be. Obviously, people will recognize higher volatility. Higher volatility demands a higher risk premium. But I'm not sure we're stuck with the decline in property prices net as a US dollar investor that you might expect.
I'm not sure if you guys have realized this, but as the conversation is going on, we're sort of tempering the risk and worry a little bit. What happens when New York opens this evening? Do you think the US, which definitely lives in its own bubble in many ways, will go, well, Trump said something nasty today? Or is it going to be a shock to the stock market in New York?
Well, it's happened so many times in the past when we in Asia, we try to bring down everything with our sentiments, and then US comes and they take it in a much better, economic perspective. So I wouldn't be surprised if something similar happens again. Again, you need to be aware of liquidity issues, Asia time trading, US markets, and of course, you've got a much better institutional framework back in the US from institutions trying to rebalance whenever markets sell off too much on external events. So, yeah, it's...
But is this enough to temper the Fed? Is this enough to keep the Fed on hold?
For the next couple of months, probably yes. But fundamentally, I think by the end of the year, the Fed will again be talking about being behind the curve and needing to raise rates. And you couple that with the central bank in the UK that probably is going to need to cut rates at least once. I think we can bounce off 130 wherever we are now, 5. I think we'll end the year a lot lower.
I really would like to open it up to questions around the room. We have a microphone, so if you'd like to give us your name and organization, that would be fantastic. Questions for all of our panelists. Who'd like to go first? Right over here in the front row.
Hello, it's Jan Eger here from Thomson Reuters. My question really, we've heard a lot about the trade effects, possible trade effects on the EU-UK relationship, but of course, what we don't have at the moment really is a single market for services. That has never been completed, and it's very doubtful that that would be completed at this stage, given the level of opposition really stemming from a handful of countries towards that. So, given that a lot of the output coming out of the City of London really is services, whether it's in the audit or financial services world, how do you measure those effects on the one hand? Also, what do you think the political fallouts will be, and in particular their financial impact then if we're going to see possibly, I've heard rumours that EU Commissioner Jonathan Fall for Financial Services would resign after a Brexit vote, as well as key MEPs who sit on the Financial Services Committees. And I've also heard that on things like CCP recognition and questions between, in particular, the banking union and non-Eurozone members, that a lot of the concessions made, or you can call them concessions, towards London will be taken back.
I'll pick up some of that. I wouldn't want to comment on the politics, not being a Brit. But I think the challenge for the UK is that the EU has never signed a free trade agreement on financial services with anybody. So if London thinks that we can negotiate that, the same kind of access to continental European finance that we have currently, I think they're dreaming. So UK-based institutions that don't have a legal entity on the continent will not benefit from the single passport, but I suspect that most do or will. So I don't think this means a third of bankers from London move to Paris or Frankfurt, but there probably will be some, because if you're licensed as an individual in London but not in Paris or Frankfurt, it is inconvenient to travel. Somebody's going to have to chaperone you, and eventually somebody's going to say, why don't you just move? You talked about the CCP recognition. I think that is one of the clearest sort of concrete measures that the French have said they would like to do tomorrow. Now, it'll take 3 years, but I think in part of their views to negotiating this is if we're going to have derivatives traded on exchanges denominated in euros, that should be in the Eurozone, which I think, so I think it'll be things, institutional changes like that. I think you will see some people leaving, but not a wholesale departure of bankers. It's inconvenient, but it's not the end of the world.
Keith, Peter, any views on political implications? Are we going to see politicians lining up and resigning, major statements from European Union heads, etc., rolling out over the next 24 hours?
I'll pass on that one, I think. Again, too early to tell, but...
You'll definitely see the latter, for sure, today. Yep. From France and Germany, the EC, the Commission and Parliament, you're going to see everybody in the continent standing up and saying the European Union is a wonderful institution and those silly Brits have voted themselves out.
Yeah. In Britain, as I said earlier, I think it's very uncertain because it's not really clear who has a mandate as a result of this. You know, you can argue it from the kind of the Boris Johnsons and the Michael Goves who are on one side of it, but you can also argue, you know, it does seem like there's been a lot of traditional Labour voters who also voted to leave, but aren't necessarily supported Conservatives. I mean, there may even have to be an election. I mean, that's all very unclear. I think what I would say, as far as the relationship with the EU is concerned, I mean, we don't really know. I mean, we're talking about unpicking 40 years of integration, and that means a lot of things are up in the air. But yeah, I think the instinct will be that, you know, where people have tried to sort of carve things out, you mentioned CCP, you know, the central clearing platforms earlier, where already attempts have been made to try and sort of bring those onto continental Europe. The UK in the past was able to, you know, through European law, resist that. Once they've left, they will no longer have that option. So they will be at the mercy, to a certain extent, of whatever continental Europe does.
Time for a couple more questions. Over here, please.
Hi there, Aaron Penn from Nomura. Just to carry on the political theme, just on the other side of the Atlantic with the US, one of the key reasons for leaving for the Brexit camp was that we could negotiate another even more special relationship with the US. But then Obama obviously came over and said, "Well, sorry, mate, back of the queue." So what happens now with America, the special relationship, and also was Obama just making rhetoric? Because we forget that from a military standpoint, there's a lot of UK air bases and stuff that the US used to, for example, transport prisoners to Guantanamo Bay. How does that come into play when we now have an independent United Kingdom? Thank you.
Well, it also depends on the US elections as well, but everything's up in the air now in that sense.
One would think that the UK government has even the UK government has some limit to its institutional capacity to negotiate with the European continent and the US at the same time. So I suspect that that special relationship will remain, obviously, but the US will wait for Europe to sort out the UK to sort out its European relationship before they start negotiating with the UK.
One more question, right over here.
Hi, my name is Nelson from Dragon Capital. We'd like to know about the short-term and long-term impact on gold price.
Vinay, over to you.
Well, I feel that that is obviously, I mean, one of the things which goes against gold is high real interest rates, you know, and we're talking about negative rates, so that's a support anyway. And the more you have concerns about counterparty risk, about the global system coming into stress, the more people put money into gold. And of course, you don't have the cost of carry against you at this point in time because you never know. You know, gold at a zero cost of carry might actually be good when you have to pay 50 bips or 100 basis points in some other parts of the world. So my feeling is gold goes up for sure. It's gone up already. Maybe goes up a little bit more. But as the problems sort out, the appeal for gold should wane. You know, I mean, I don't know what the political scene is, but could they have another referendum while they negotiate the process? No?
It's unthinkable. But then, so was this result. So I don't. I mean, who knows? I mean, there could be another Scottish referendum. You know, I mean, there's sort of all these things are up in the air.
Yeah. So you know, you got to again kind of play it as things evolve instead of kind of looking at a 3-year down the road picture because there's going to be a lot of posturing. There's going to be a lot of. I mean, you look at the people in U.S. again. I'm talking about the pre-Trump era, and you look at European Union. On one hand, they'll have to convey a message to other EU members that, hey, exit is not going to be good for you guys, so you stick to EU. On the other hand, they will try to offer a deal which doesn't harm the economic interest. Because, as I said, A, military considerations, it's a very important part of the Western Bloc, UK. B, you know, the threat of terrorism is rising, therefore, united you are, the better it is to find that threat. And C, you know, there's a massive trade linkage with UK. So you know, it's going to be messy, unclear, cloudy, nebulous, whatever, for periods of time. But I guess you got to play it by the book. I mean, as it evolves, my feeling.
Okay, we're just going to take one last look at where we are. The Leave leading by 3.6%. Before we go, panelists, on a scale of 1 to 10, 10 being the heaviest of implications, where would you rate a Brexit as heaviest of implications being 10 on a scale of 1 to 10? Just need a number. Vinay.
Yeah, we can start there.
Peter, I'll start with you. Put you right on the spot.
You want me to set the range? Is that what you want to do? Well, I'm slightly conflicted on this because I live in Hong Kong at the moment, but in about a month's time, I'm going to be moving back to London, and I foolishly forgot to ask Reuters to put a Brexit clause in my contract. Look, I think sitting from this part of the world, I think, you know, it's primarily a UK political event. I think it has some, but it definitely has severe economic impact and political impact on the UK. There's some knock-on to the rest of Europe. I think once you get beyond that, I think it makes the world economy a little less certain, and growth possibly a little slower, but not dramatic.
Okay, so I'm not going to quote you guys on this. Is that a 5? Is that?
Well, I think it depends where you sit. I think if you're moving back to London and you own property in London, I think this is like the biggest political event I can think of in my lifetime. You know, the most consequential political decision that has been made. You know, even elections, you can talk about Blair getting elected in 97 or something like that, or Thatcher getting elected in 79, but elections, there's another one every 5 years. I mean, this is a once-in-a-generation decision, and it's gone one way rather than the other. So I think for everybody in the UK, and I think in the sort of the immediate circle around the UK, I think it's very consequential. But I think when you get beyond that, if you're in Hong Kong, you know, stuff happens.
All right, Keith, 1 to 10. Where do you put yourself in that band?
Well, I don't think Peter's made it any easier to answer this question. I'm kind of with Peter. I think globally, with some of the things that the rest of the gang have said, I think globally, yes, this is going to be a bumpy ride for a period of time. There is more uncertainty. in the big scheme of things, is China still going to be producing 6% growth in GDP? Hopefully. Is the rest of Asia going to be producing that sort of GDP growth? Yeah, hopefully. Are we going to see things in other parts of the world? Yes. You know, there will be other factors out there. Is this a long-term blip? You know, I'll say hopefully, because I hope we don't see a domino effect in the rest of Europe and the economic consequences that come with that. So maybe it's a 2 for global. But again, if I'm, you know, very sympathetic to Peter's personal circumstances, if you are, you know, in the UK, you are invested in the UK, you know, irrespective of what happens as the politics and all the other things work through, I think investment sentiment towards the UK is going to be dramatically dampened. Just because of the uncertainty that's been created, and that's not going to be a good thing. So I'd probably say that's a 7 or 8 in terms of impact.
Okay, Michael Spencer, 1 to 10.
I'll call
I'm
it
working
a 6.
on numbers here.
I'll call it a 6, not for the economics and the near-term financial perspective, but I think it increases significantly the underlying political risk in Europe. It makes conceivable more things like we could have a referendum in Italy or France within the next couple of years. You could see other countries trying to do this. And it may be, as you were saying earlier, this may be the beginning of really a significant change in institutions where we all have to get used to it being harder to move people, goods, and services around the world. And that is not in anybody's interest, but that could be what's beginning.
Vinay, final word from you.
Yeah,
Number from you.
The final, the most important word is reading through Peter's comments. He does own property in UK.
Yeah. On a scale of risk.
Yeah, I mean, the biggest risk beyond, say, market volatility to me is domino political effects. What kind of message it gives to politicians in EU, what kind of message it gives to people in the EU. Could somebody on the either far right or far left in one of the EU countries get up and say, look, the people of Britain voted to choose their own destiny. It's time for us to choose their own destiny. I mean, these slogans can change sentiment, and they can be fairly bad for risk. So if there is no domino effect, and I'm no expert in most things, to be honest, but yeah, then I would think it's 5. I mean, we should be used to market volatility. There's nothing great in that. But if there's a political domino effect, then it could be anywhere between 5 and 10.
Well, clearly there's a range of things to think about. Political, financial, trade, etc. Gentlemen, thank you very much. Vinay, Michael, Keith, and Peter. We'll keep track of what's happening, and thanks very much for sharing your views today.
Thank you. Thank you.
Tara, panelists, thank you very, very much. Absolutely fascinating insights, and that ability to give sensible, considered judgment as the news is coming in around you is remarkable. And I thought that the range of factors that the panel covered, short-term, long-term, economic, political, what it's going to look like for Asia, I think gave us all a huge amount of content and thought to go away with. I'm not remotely going to try and summarize that, and I wouldn't dare to. Just a couple of reflections. It looks as if what's been happening with the vote in the UK is if, in particular, working class voters have voted for exit in larger numbers than predicted. They have abandoned their loyalty to the Labour Party and moved over to the other side of the line. And that seems to be one of the key swing factors, one of the things that people got wrong. I think there's something here about wider politics. You know, people have referred to the Donald Trump effect, the Bernard Sanders effect. There is clearly a strong anti-establishment voice here. Virtually all the mainstream political parties in the UK were in favour of big business, President Obama, President Xi, you know, and this, at the end of the day, the people spoke, and they spoke against that. So what's going on here? A lot of people who maybe feel they're losing out from the system, that they haven't seen the benefits from the system, particularly they've had a tough time over the past few years. So I think there's a lesson here for policymakers more widely, perhaps most immediately in Europe. I think secondly, a number of the panelists have said, you know, there's a short-term reaction today, but you know, we're going to have to look at what this means in the longer term. I think it is worth bearing in mind that, you know, the vote is clearly going to be out. It looks as if it is. That doesn't mean that on Monday morning, Britain is going to be out of the European Union. You know, things carry on as they are in terms of structures, trading relationships, the legal framework, so forth and so on. The process will start under Article 50 of the European Union Treaty. There's a 2-year timeline for that, which will negotiate the terms of British exit and the future terms of British engagement with the European Union. So there's a lot to work through there. And one can't make predictions about how it's going to play out. But I think that policymakers globally are not going to, seems to me, want to make decisions which risks things being even worse on a global sense. I think secondly, the UK is a big, important economy, and people, I think, are going to be reasonably grown up about this and going to want to have sensible grown-up arrangements going forward. Please don't any of you quote me on that, but I think it is important just to stand back a bit and look through today and actually think, well, this is the process that we're embarking on. Thank you again to the panelists. Thank you all for being with us. It's been a pleasure. And this has been, as Tara said, I think we've been sort of witnessing a bit of history today. Thank you very much.
I think so, Andrew, without, just to end it, the Reuters story is out. Britain votes to leave EU in historic divorce. So it's happened, basically. The news is out.
Thank you very much, everybody.